All right, time now for our calls of the day. First up, CSX and Union Pacific both getting downgraded to market perform from outperform at Bernstein. However, analysts say it is not a call on the possibility of a railroad strike. Jim, you own Union Pacific.
Yeah, I do own Union Pacific. I discussed this also on Monday as well, that this strike is a big potential. It's something that will eventually be resolved. The problem is not so much for Union Pacific and the other railroads. It's for the economy at large. I mean, this is the last thing our fragile economy needs at this point in time. But again, relevant to these stocks, you know, this is something that they will get through. And when the economy recovers, all the factory building, all the supply chain onshoring, infrastructure spending that's going on, you need the railroads to transport all that materials, still have strong labor markets, which begets consumption. The railroads are going to be fine. You just got to get past this strike.
So long-term hold here?
Long-term hold.
All right. Next up, Merck upgraded to a buy rating at Berenberg. Analysts actually saying this is a low-risk value option in the pharma sector. Joe, you're in this one.
Good spot to buy it here as well. It's pulled back right up against the 200-day moving average, which sits down at around 84.29. I've owned Merck since the mid-70s. I believe this is a company that offers the perfect hybrid between offense and defense, works in this environment. And clearly, healthcare over the last couple of years, it's been ignored by investors, and certainly with a significant valuation discount of nearly 20% relative to the S&P. That's where it began 2022. I think you want to take advantage of that. But with the defensive positioning that you need right now in the market, Merck is clearly one of the leading names to own in the healthcare sector.
Carrie, over to you. What are you thinking about healthcare right now?
Well, a comment on healthcare really needs to look at different types of healthcare. So in the biopharma area, it's all about whether a company has a drug in development that will be approved by the FDA and it will treat some ailment, some unmet disease need. And unfortunately, what's going on right now, in part because of labor shortages, is that every clinical trial is being drawn out because there's not enough people who can take the blood and process it and process the people and get the patients in clinical trials back, into the hospital and have normal operations and the normal conduit of how clinical trials need to operate. There can be 10,000 patients in a trial. And so if you go from this is going to be done in a year to this is going to be done in 2 years, that slows down the whole process. And I think that should and might be weighing on all of the drug and biotech companies today. So that's just a comment I would make sure people are aware of.
All right, Carrie, another one of your holdings, Raymond James upgrading PayPal to outperform from market perform. Thesis here is that this is actually the kind of stock that you want to own right now, saying PayPal is exactly the type of stock you want to own in this tape. Defensive growth driven by secular tailwinds, significant free cash flow generation, clean balance sheet, et cetera. Shares up more than 1% right now. Carrie, do you believe this thesis and agree with it?
Yeah, I do agree with that and believe that this will happen. What we've seen with PayPal is that stock came down so much, so hard, that almost all the people who have lost money in PayPal are out of it. There are an awful lot of new buyers who bought it over the last couple of months. They're happy. They're making money. It's a stock that has a really nice-looking chart today. They found religion. They're cutting costs. They're committed to operating margin improvement. They're activists in the name, and they're starting to see a renewal of double-digit, mid-teen sales growth, heavy free cash flow. They're buying back shares, and so yes, we think that PayPal can trade up much higher. And of course, the multiple has been cut tremendously over the last couple of years.
Yeah, tremendously, about 66% off of its high, but to your point, month to date up about 3.5%.